Hi there. My name is George Finder. Sitting next to me is Thomas Key. I am an independent credit evaluator. Tom is a litigator of some renown and experience, and we are going to talk tonight about the liability for credit damage.
Okay.
Okay?
Thank you, Mr. Finder. This chapter is the second chapter in the book on credit damage assessment. We're looking to certify expert witnesses and attorneys who can approach credit damage, and we're providing this background. This chapter is devoted to the concept of liability, and it ties in with the rest of the program very closely. But tonight we will be talking about some of the abstract concepts that the law deals with. If you're not an attorney, you're going to be working with attorneys. Attorneys will be hiring you. Attorneys who do not hire you for your expertise and familiarity with the legal standards that they're held to probably shouldn't hire you as an assessor. And so we will be touching upon professional responsibility as well. In other words, when an attorney hires an expert witness, the attorney is still liable for what the expert witness does, who they contact, and if they do something wrong, if they violate professional ethics. For example, if an attorney participated with an assessor who was practicing law without a license, the attorney would be directly in violation of professional rules. In addition, the idea of making meritorious claims, which is a professional ethics requirement. We can't pursue claims that are not meritorious. If tonight's topic is liability, if the defendant that the attorney is working on has no liability and an expert determines that, or a non-attorney working with the attorney realizes the case is not meritorious, he would be facilitating an attorney's violation of that professional requirement. Now there are MCLE units for professional ethics available, as well as ultimately preparing you for this new career as an assessor or preparing attorneys to take on the additional category of damages, which is known as credit damage. We're going to be touching upon the concept of compensation, responsibility, and most attorneys will take as a theme, if they're on the plaintiff's side, they'll take the theme of holding the defendant to be responsible for the consequences of their act. And interestingly enough, if you're a defense counsel, you also might consider the same theme of asking plaintiffs to take responsibility for their acts. In other words, responsibility is very much a two-way sword. The point we want to get across this evening is that it is a sword. Now, a person suffering from a detriment or injury is entitled to seek damage. That is a fundamental part of justice. It's in the Civil Code 3281 in California. Basically, I want to read that code, and it's widespread across the different jurisdictions. A person suffering detriment may recover damage. Every person who suffers detriment from the unlawful act or omission of another may recover from the person in fault a compensation, therefore, in money, which is called damages. Now, the walk-away point on this is that we are compensating victims no matter what their damage, what their injury. It might have been physical, it might be emotional, it might be financial, it might be their reputation. We are compensating these people with money. Now, is money an equivalent to the loss that they took? The law treats it as an equivalent. Now, notice that it basically puts the burden on the victim. It says the victim who has already suffered the detriment may seek the compensation. Nothing in this universe gives money to that victim. The victim has to seek it. It is something the victim then has to prove up. And of course, that's what protects defendants from frivolous claims. But basically, this concept of liability coupled with compensation is our way of holding people responsible for the consequences of their choices. Now, they may have made the choice not to choose. They may have chosen to neglect. They may have chosen to be indifferent or ignore or protect themselves from knowledge of something. But fundamentally there, the law is looking for that choice, that intention, that will. And in California, as in most, well, I gotta say there are 50 jurisdictions. I think Louisiana may be an exception. That have basically two approaches to liability. And we're talking about liability this evening. We're going to focus on liability for credit damage. Let's just think a moment. Let's go back to the fundamentals of what makes somebody liable. In the case of credit damage, liability may depend upon whether there was a breach of contract or any other type of act, which we would call a tort in civil recovery. In other words, we make a difference between a breach or a contract action and a tort action. And you can ask why. Fundamentally, the victim of a breach of contract is not considered as culpable as a tortious or somebody who's actively, it's not considered as bad. So the measure of damages should be different, and it is. What's the measure of damages in contract? Civil Code 3300 in California, and I'll read this. For the breach of an obligation arising from contract, the measure of damages is the amount which will compensate the party aggrieved for all the detriment proximately caused, or which, in the ordinary course of things, would be likely to result. And that's your foreseeability. The contract damage, in other words, in order to be recovered, must be foreseeable. The consequences have to have been foreseen or foreseeable, not necessarily foreseen, but foreseeable by the parties at the time. And the key here is that in contract, you know who the parties are. You have parties to the contract. In tort, you don't necessarily, victims and tortfeasors don't necessarily choose each other or know who the other is in advance. In contract, the foreseeability, if the consequences, say credit damage, is foreseeable to the parties, the victim could recover for it. In other words, the victim of a breach. And tonight, I want you to think, if you can think of a contract in which the parties would not be contemplating credit damage. George, can you think of any that...
Well, I have some questions.
Where parties to the contract don't foresee credit damage for breach?
I would think almost none of them do.
I think today, in today's transactions, which are filled with this concept of credit, the consequences of somebody breaching, in other words, the victim doesn't get a payment or they don't get performance of the contract, and that exposes them to a change of plans, and one of their plans would be to stay current with their obligations. that breach may hamper that plan. And if it does, they then would foreseeably not be able to stay current with their third-party obligations.
So-
It is a third party.
So that I'm clear on this,
Right.
you and I enter into a contract. We're going to create a roller skating rink. You're going to build it, I'm going to run it, okay?
Right.
Things don't go well. I don't pay you money that I'm supposed to pay you, so you can't complete the contract, the construction, either in a timely fashion or at all. Okay? Because they don't pay you, you can't pay your bills. I did not think of the consequences of my not paying you beyond, oh my God, I'm not paying you. Am I liable?
Yes, you are. Because even though you didn't foresee it, the credit damage was foreseeable.
Okay.
And so that's the distinction.
Okay.
Thank you. I want to cut another illustration in here, and I think attorneys are going to smile with the recognition of the case, Hadley versus Baxendale. And this is the case is not that old. It's 1854. Remember, this is at the beginning of the Industrial Revolution, and the facts highlight some of the causation issues that are raised when a breach occurs. Mr. Hadley operated a mill, a grinding mill. The mill shaft broke and had to be replaced. Hadley, the owner of the mill, hires Baxendale as a kind of a courier service or a shipping service to cart the broken mill shaft to an engineer in town who could replace it or replace the mill shaft. Now, Hadley tells Baxendale that the shaft has to be sent immediately, and Baxendale promises to deliver the shaft the next day. Now, this is a mill shaft. Baxendale, of course, doesn't know that the mill would be inoperable until the new shaft arrived. Now, that's the given facts that the judge gives us. He understands, or he believes, that Baxendale wasn't told that the whole mill would be shut down as a result of a broken mill shaft. I just want you to question some of these facts as well, though. Part of the takeaway of this case, Baxendale versus Hadley versus Baxendale. Hadley. Part of the takeaway here is we learn to question some of these facts. Now, Hadley, the owner of the mill, sues Baxendale. What does he ask for? He sues him for the money he paid to ship the shaft, which came late, and he also claims damages for lost profits and wages. And the jury awarded something between the two amounts. The jury did not give him all the lost profits and wages, but awarded considerably more than just the price of that mill shaft and the cartage fee. But what are the damages for breach of contract? The court here said in Hadley versus Baxendale says that the injured party may recover the damages considered to arise naturally from the breach, and the damages that are reasonably contemplated by the parties at the time. In other words, the court held the non-breaching claimant entitled to the amount he would have received if the breaching party had performed. If Baxendale had come back with the mill shaft the next day, there would not have been the lost profits.
So, if I may interrupt somebody getting shafted, I have a question. Let's take a health insurance issue.
Okay.
Health insurance is contracted, whoever pays for it, the beneficiary goes to medical services, medical treatment, everybody performs their job as they're supposed to, and the insurance company is supposed to pay the treatment provider. The insurance company, for reasons beyond expectation, instead of paying the bill within 30 days, pays the bill within 6 months. In the intervening 6 months, the treatment provider holding the treated individual responsible for the bill, because the treated individual typically will sign an agreement that they are ultimately responsible for this treatment financially, turns the matter over to a collection agency. And the collection agency goes after the treated injured party. In the middle of, or after the collection has appeared on the injured party's credit report at some point, the insurance company finally pays the bill. They pay everything that they're supposed to pay, but they've paid it 6 months or more late, and the treatment has been successful. But now, as a result of the negatives appearing on the credit report, there's reputation damage, there's loss of reputation. That, to me, would be a foreseeable consequence of not paying bills. Is that a compensable situation?
Absolutely. It's foreseeable, and here you have a case very similar to Hadley v. Baxendale, where there was performance, but it was late. They did pay. Now, are the damages limited to not having the money for 6 months? Or would the damages include the foreseeable
erosion of reputation,
impact on the credit reputation, which very foreseeably would occur within 30 days after non-payment by a third party? And in that case, the credit damage, the amount recoverable as credit damage would far exceed the amount that the covered party might have recovered for the late, not having the money for 6 months.
Right.
And it's the credit damage that would give legs to that claim.
Let's make the claim even a little more complicated. Let's assume that they were in a high security job, the injured party. Let's assume that they were a Navy SEAL, just to make it interesting, or similarly high risk job, okay? And because of the late payment, Navy SEAL is a bad example because the military would take care of those expenses, but a civilian equivalent to that, their security clearance is affected because their credit score went down, because they had collections, because the bill was not paid. And as a result of that, they lost their job or were transferred to a lower paying job.
In other words, you have the impact of credit in today's society. Credit may be looked to for security clearances, it may be looked to for employers, and it is a very clearly compensable loss. The problem is liability here. Can we, and that's what we're talking tonight, who would be liable, and what would the theory be for extending that liability? Here we're, in that case as well, looking at a contract and whether the loss of security clearance is a foreseeable consequence to the SEAL.
My question would be, if we know that the negative information is going to appear in the credit report, that's very foreseeable, and we know that the negative credit information impacts the credit score of that individual, no matter who's running it, no matter who's providing the credit score, whether it's the credit bureau or whether it's the credit scoring company or whether it's a lender or an employer who has requirements. Your score must be higher than a specific number, or we will not employ you, or we will not employ you in that type of work. So we know that there's a foreseeability of that erosion, that loss, that damage. So we have a scenario where there is clear liability, and it's just a matter of proving that liability, or excuse me, the damage, proving that damage.
Right.
And that's where the credit damage assessor plays a vital role.
Exactly, and this need for assessment, need for somebody who can liquidate that damage, is needed across the whole range of these cases, from breach of contract to tort. Now, just to finish up Hadley v. Baxendale, the case also includes the recovery of special damages, and one of the questions with credit damage often asked is whether credit damage is special or general relief. Clearly it's a little of both. And if you're looking to find the actual numbers, the out-of-pocket losses of special damages, you can find them in credit damage, and also you can find in the fact that it's a reputational injury. You can find general relief, in other words, general damages for mental distress and even these pain and suffering categories. So when people are working on the credit damage recovery, you're in a category that has both out-of-pocket loss and the kind of mental distress category of general relief as well. Now,
I'd like to jump in here. Mental distress certainly is another label, in my opinion, for loss of credit reputation, because with that loss there are things that you probably expect to be able to do based on your history and your previous performance that you cannot do anymore. And so, does it make any difference as to which category loss of credit capacity falls into? Does it make any difference which category, general or special, loss of expectancy falls into? And certainly out of pocket. Out of pocket has several components which we will get into at another time. But these three facets, do we try to categorize them? Do we need to categorize them?
don't need to, but it may be useful. Attorneys like to build the case on the out-of-pockets, and then you want to reach appropriately to encompass or cover and compensate for the more abstract distress type damages. But don't overlook the fact that credit damage enables you to do both. You have the benefits of having a special damage, the out-of-pocket lost credit, and you also have that reach into general damages that are not as surgically precise, but also can be liquidated. So,
and with a proper presentation prepared by credit damage assessor, the numbers become very solid. There's a solid foundation that can be built.
And that's what we'll be learning in this course. Now, just to finish up with Hadley v. Baxendale, the takeaway point in that interesting case, and it's a very short case, but keep in mind that, remember, Hadley did not communicate to the carrier, Baxendale, what the consequences would be if the shaft isn't back tomorrow. He just said it's important. He said, I want it back tomorrow, but he didn't spell out to him what the damages would be. In other words, he didn't spell out, I'm going to have lost profits, I'm going to have lost business, I'm going to have out of pocket. He didn't spell any of those things out. He didn't explain the special circumstances of why he needed that mill shaft back the next day.
He didn't say I'm out of business.
Right. But the majority view today is that if it's foreseeable that there would be consequences, the non-breaching party is still entitled to those foreseeable damages. And once again, the word is all detriment. Foreseeability is the kind of the key concept in contract, and that might be why you would want to include or utilize a contract cause of action. because you might be able to reach into lost profits, for example, into foreseeable but future damages. In a sense, foreseeability is the cornerstone of a breach of contract damage claim. Let's look at damage in tort now, just to contrast it. What's interesting is that they both use the phrase all detriment. And you'll see that in the statutes, that the plaintiff may seek to recover all detriment caused by the wrongdoer or the breaching party. So we need to compass that phrase, what detriment is, harm or damage. And in torts, the recovery is typically not limited to what's foreseeable. In other words, the wrongdoer might end up being exposed to consequences of his act that he had no idea would be likely to occur and did not foresee them. Not only didn't foresee them, but they were not foreseeable by anybody. We should often look at the difference in, for example, pain and suffering. You have typically the tort victim might seek to recover medical costs and lost wages. These are foreseeable. But what about the lost credit or credit reputation? We don't need to worry in a tort whether or not the tortfeasor knew that the victim even had credit or expected to buy a car or intended to use the credit. It is simply not needed as an element or something we need to explain. You can proceed to assess and measure and quantify the credit damage, and the plaintiff may seek to recover it. Now, there are a whole range of cases that come within a hybrid between contract and tort, and I do want to talk about two of them because although the traditional heads of liability are contract and tort, there are things that are sort of between them, and the first I want to talk about is promissory fraud, and that's where you have the tortious, you have the fraud, a fraudulent intent in a promise action, where the promise is made without the intent to perform it. It's both a contract because there's a breach involved, and it's also a tort because of the fraud or the intent. So you have fraudulent intent to not do what was promised. Another hybrid sort of action is breach of fiduciary duty. This is an interesting hybrid because typically a fiduciary has a type of contractual, even if it's implied, relationship between the principal and the beneficiary, or the manager and or partners. There's usually fundamentally a contractual relationship here. There might be agreements between them, but it's fiducial in the sense that there's this element of trust between them. And here the damages are as if it's a tort, because it's not limited to foreseeable consequences. So it's a hybrid sort of between those two heads of liability, including a little of each of them, both contract and tort. These are also interesting, the hybrids, in credit damage cases, because so often we deal with the two of them, or the hybrid. It's either a promissory fraud or a breach of fiduciary duty, often, that we can look to. And the interesting thing here is that both of these hybrid theories do enable us to recover punitive damages as well as other consequential damages. Keep in mind that punitive damages are not consequential. They don't naturally arise out of the tort. They are, in addition to the tort, where there's a reason to punish the wrongdoer. And that reason might be just policy, or it might be because they're particularly bad. You have the opprobrium of the conduct that you want to send a message into the marketplace. Now, in a fiduciary duty cause of action, the manager or the person who controls property, if they have a fiduciary relationship, in other words, that element of trust where the other party has reposed confidence in them. For example, in a credit situation, often a person who is asking for credit from a lender will pass across the table their most confidential information, their financial information. It's very private. Most people don't discuss their cash flow and sources of income or amounts of taxes they pay and these kinds of things with just anybody. You would only do that with somebody you trust. For example, a bank. Now, it's true that the banking industry has legislated and attempted to shield themselves from this theory of fiduciary obligation, because it is a powerful theory. But the law can look past those attempts into what the actual facts are and evaluate the actual circumstances of the case. If a creditor or lender stepped into a position where they claim to be trustworthy, we will guard your money and we're in the business of being very credible bankers, we're in this business, and you see a lot of marketing that looks like you can trust us. We're bankers. You can give your money to us and we'll take care of it. We won't invest it in ridiculous securities that are going to lose your savings for you. If you see these types of representations, has the bank stepped into that fiducial obligation that they try to tell you that they don't have? It turns out that may turn on the facts of your case, but that is a theory you should try if you're suing a bank, any bank, on behalf of a loan application or somebody who applied for a loan, a borrower. Now, let's apply the liability concept here to the collapse of the credit markets that we saw in September of 2008. What we had here was mass credit damage. One of the reasons we're teaching this course is, we're serious about what credit damage is and how it is compensable and how it can be recoverable. We have a situation here, just as a case study, where credit reputations were harmed on a scale that was historically unprecedented, involving trillions of dollars. Now, 2 years later, have we seen the people who recovered the benefit held liable for the consequences of what they did? Let's have a look at that. There are some cases where some of the bankers who performed certain acts that had consequences have been questioned. But let's have a look closely. We know that Wall Street and the major financial institutions of this country went into complete collapse. It was announced, they went to the government and announced that they could no longer meet their obligations when due. They actually had millions of dollars due every day. Now, 2 years later, why aren't we seeing the people that made billions of dollars in commissions and salaries? Why aren't we seeing this turned back over to the victims who lost so much. There are reasons for this. And that's why we're looking at liability tonight. We're looking at the concept of liability. How does it apply here? Is the problem the fact that we know who the perpetrators were, we know who took the money, they've admitted it. The CEOs of the largest financial institutions in the United States have admitted that they have taken multi-million-dollar commissions at the same time that they were destroying their own institutions and the credit reputation of virtually everyone else in the country. Now, where did they admit this? I take admissions as a litigator. Admissions are a very high quality of evidence. Admissions are, first of all, evidence, and secondly, we look for that kind of quality because all evidence should be scrutinized carefully. But when somebody admits it beyond, consent and knowing and were they being tortured at the time, we don't have to go too much further. We can accept the admission. Now, did they admit culpability? No. Did they admit that they were liable for anything? No. What was missing? All they admitted is that before they destroyed their own institutions, they had received the pelf, the money. They had received a lot of money. Is that enough to impose liability? That's why we're looking at liability tonight. We want to understand that link. How does it apply in a case study like this? And we just choose as a case study the biggest transfer of wealth in history. The financial collapse of 2008.
And 9 and 10.
Well, it really happened in one summer. The collapse of the institutions, the large institutions. Every month we're hearing of another bank going down. That's true. But in the run-up to 2008, we saw consumers in both, commercial and consumers of credit incurring unprecedented amounts of debt. We know that debt was basically underwriting a kind of prosperity or the appearance of prosperity. People were buying, but they were buying on debt. They were buying by borrowing. We know that the scale was amazing. It's really unbelievable in amounts. It's a little hard to calculate in our written materials. And by the way, the chapter materials, you have to get this and kind of look through it. But I do try to give you numbers. I like knowing what those numbers are, and we'll talk a little about that in a minute. But basically, the first position mortgages, not including the seconds, and there were billions of dollars in the seconds, but on residential property alone, the first position encumbrances were in excess of $9 trillion. And that's across over 50, 60 million different properties, homeowners, and different properties. In the consequences after the collapse of the financial system, most of those houses sort of went upside down. They were no longer worth as much as the first, not including even the second. But the equity in the house wasn't worth as much as even the first. And you had then something like 50 million properties exposed to default. The total amount of value that disappeared in the morass of toxic investment products, and here I'm turning to the investments, the pooled investments, most of them were pooled, that are from retirement funds and people's 401ks, and just investors that are trying to get a return on capital. The disappeared money in equities has not been tallied. Why can't we tally it? I want to go through some of this to appreciate the scale of what we're working with here. The nature of, first of all, the nature of some of these investment products, we call them toxic because we use that word because they had no marketability. We couldn't market them, and so we can't say how much they're worth, and we can't market them because we don't know how much they're worth, but we can't count the amount that they even reaching the underlying mortgage-backed mortgage. You know, if you have a mortgage-backed security that's been layered and tranched and repackaged 50, 70 times, one can no longer actuarially appraise the value. You can't get a kind of appraisal of what it's worth anymore. It becomes qualitatively unmeasurable. Now, it is another thing that reason we can't tally the damage that was done to the country is that the banks own the data, and they're not willing to tell us or produce an account of how much they lost. Why would a bank want to tell you how much money they lost? Their reputation. So you have a kind of reputational concern that the institutions have. They value their reputation dearly. We want to suggest that as we look at credit reputation, we're not asking banks to do anything that for a consumer that they themselves aren't asking for us to do on their own behalf. They want to protect their credit reputations. That's so valuable to them. It's worth trillions of dollars. We suggest that to consumers and commercial and business people, their credit reputations are also worth something. And if they're damaged by what the financial institutions did, they're entitled to that recovery. I want to mention a third problem with trying to tally the total damage caused by the banking collapse is the fact that it is a moving target. Fundamentally, a mortgage-backed security is based on what the mortgage is, or what the property secured by the mortgage is. The property is the security, and the value of the property keeps changing. So in a sense, and as the toxic securities are continuing to be traded, interestingly enough, we're trying to value or look at a moving target when you're looking at the big picture. Now that is the rationale, because we can't measure that, or we can't even get a real clear picture of it. What we can do is take each consumer one property at a time. We can measure that. We can train you to measure and go out into every state and measure the damage caused to each homeowner. We're going to recover the damage one piece of property at a time, one option arm at a time, one loan at a time. But we do have to deal with the fact that the scale is large. And of course, that's why we're going to go back to the fundamentals and look at liability. What does that theory mean? What does it do? And how do we engage it on behalf of clients? Now, your clients may be the defendants, may be the plaintiffs, but what we're looking at is this arena where people are using credit. We talked last week about George Simmel, who predicted the kinds of uses of credit that we have today. Now, some of the questions we want to kind of review, and you can engage your imagination with, is how many homeowners had built a lifetime of good credit and then were lured into a refi or a drawdown or line of credit secured by their house, or converting their credit cards into non-dischargeable liens against the house. Yeah, there were lots of new products and packaging and interesting ways of, consumers were told to use the value you have in your house. After the collapse, they were lured into a program of loan modification. Now, loan modification, after a major financial collapse, would be a win-win solution for everyone. The lender would get continuous cash flow, although reduced. The borrower, because of the collapse, may have lost income, may have reduced income, may have lost their job, may not be able to pay, or even if they still had their job, the borrowers were facing a new instrument that had been introduced since probably 2006 or 7 to the consumers, option arms. Now, option arms are interest-free for a short period of time with teaser rates at the beginning of a loan, and then have a trigger that doubles, and I have seen one that had increased the monthly repayment by 10 times.
Just so there's no confusion, ARM is an acronym for Adjustable Rate Mortgage. And what happened in many of these circumstances, many of these transactions, is a fast-talking but very trustworthy loan officer, loan broker, loan originator, someone who took the position that I have money that you want, and you have equity in your house that I can turn into cash into my pocket. So let's make a deal, and I'm going to make it real easy for you to get the money out of your house through me, so that you can do things that you want to do and I can do things that I want to do, and we're both going to be happy with the adjustable rate mortgage. That adjustable rate mortgage, if it was not properly explained to the homeowner, all they saw was, hey, I can get $10,000 out of my house and I can take a vacation, or I can do whatever it is that they want to do with it. My wife needs new dental work. My son wants to get a new car. I want to get a new car. Depending on the amount of the equity in the home, that adjustable rate mortgage had what we call a teaser rate, so that maybe you didn't have to make a payment for 2, 3, 4, 5, 6 months. Maybe your first month's payment was $1, and the second month's payment was $2, and the third month's payment was $3. The structures were very creative, but the result was always the same. The easy money period, the low payment period, ended before anybody realized, either logically or emotionally, that it was going to end, and they were not prepared for the change. In many cases, the nice, friendly lender said, well, don't worry about it. When it comes time to do that, we'll just refinance the property again, and your payments will drop again, and life will be good again.
And in fact, George, or Mr. Finder, we do know that the lending institutions would train the brokers to say exactly that. In other words, the broker would ask in these training sessions, what about the home borrower, the homeowner, who's a borrower, asks, well, I don't want to pay these, 10 times the amount in 2 years. What do I do after 2 years? and they were trained to assure the homeowner that we're lenders. We're in the business of making loans. We will refinance your old loan and give you a new loan.
And
We'll replace the obligation with a new obligation.
And nobody paid sufficient attention to the change, the jumps, the adjustments from easy payments to totally unaffordable payments because the adjustable rate mortgage adjusted. This was very predictable. This was in the contract. And in the origination and completion of the contract, one of the basic requirements of a loan is that the lender is able to have confidence that the borrower will be able to meet the monthly payments. At any point that a lender has a feeling that a borrower cannot meet the monthly payments, whether it's an adjustable rate payment or whether it's a fixed rate payment, and in a fixed rate payment that simply means nothing changes. The payment that you make the first month is pretty much the payment that you will make the last month of the contract, whether it's a 15-year note or whether it's a 30-year note. Now, the adjustable rate mortgages became very creative, and they did this by saying, well, look, it's going to be a very low payment, and I'm going to use $1 for example purposes, for the first 5 years of this note. You're going to pay $1 a day, so $30 a month per month is going to be your mortgage for the first 5 years of this note. Could have been 1 year, could have been 6 months, but a 5/30-year note was very common. And everybody likes free money. Everybody likes easy money. And everybody did not separate the difference between earned income and borrowed money. Now, when the lender realized, based on the amortization schedule, that amortization is the predictable change in the payments on that mortgage, the lender did not pay any attention to the point at which the income of the borrower could not make the payments of the monthly obligation.
Now, I want to emphasize that point, that there is no person drafting one of these instruments, an option arm, say in 2008, 2007, 2009, to a consumer to buy a home or against their home. There's no person drafting that instrument or marketing it or sitting down and presenting it and getting the consumer to sign it who could imagine that that consumer in 99.9% of the cases would ever be able to pay back that option arm on the terms of the option arm.
So they disregarded the terms. The affordability on the part of the borrower.
Yeah, I challenged in Congress, at a hearing in Congress, I challenged the lending industry to show me one option arm that had ever been paid on its terms. In other words, a consumer had signed the option arm obligation, and in spite of the jump up and in spite of the shock payment, they continued making the payments and paid it off. And of course, their industry didn't have one. The industry did come back a few days later, oh, Mr. Key, you were wrong, we had one here. They found a very wealthy man who bought out the option arm, paid the prepayment penalty, was over $20,000, which was nothing to him, and he was doing it for his daughter. In other words, he wasn't buying his house. This is a case that proves my point. It is not an exception. There is not, to my knowledge, and to any real estate practicing attorney, I've 20 years in it, we don't know of an option arm that's ever been paid on its terms. Now, why that device was put, why borrowers to buy their home were placed into those instruments in the first place should be examined. In other words, why would you put somebody into a short-term obligation designed to be paid off immediately within usually 6 months? See, the instrument is not new. Option arms have been around for many decades. The application is new. We had never seen them being used in purchase money homeowner contracts before. This was a fresh, new product. And we have to look skeptically at any financial instrument that claims to be a new product. Usually what the financial industry, what they did is they took instruments and devices that had been used in the 1920s and they reintroduced them, in the year 2000.
With the same effect.
With the same effect. And what we'll be discussing after the break is this foreseeability concept again, and applying it to our loan modification or our real estate people whose credit has been damaged as a result of a real estate transaction. I want to emphasize, though, this is merely our case study application this evening. Believe me, assessors can be used across a wide variety of cases. The fact that this happens to be a big one, we do want you to be familiar with it because it's something that most practitioners with 50 million homeowners who are in trouble are going to run across. So we'll talk about it in a little more detail after the break. Thank you.